You're joining us now, Bleakley Financial Group Chief Investment Officer and CNBC contributor, Peter Boockvar. Peter, good morning.
Hi, Mike. How are you?
Good, thanks. You know, the last little up leg in the stock market started with the CPI report for October, which was on November 14th. It seemed to get everybody on board with this idea that disinflation is well in train. You had the bond yields on the 10-year Treasury back off from 4.6 down below 4.5. So that seems to solidify this idea that inflation seems like it was 2022's problem and the Fed is done. Do you take issue with that?
No, not right now. I mean, certainly the moderation is also lending support to the belief that the Fed is going to cut interest rates by 100 basis points through the end of next year. And I think that is also a major catalyst for the stock market rally, because who, after all, doesn't want to miss a Fed is done rally? I think the real question with inflation is after this moderation, because that's what happens. You get an inflation spike and you get the come down. And where does inflation, though, eventually settle out at? Because that's going to be a key determinant to the extent at which the Fed can continue to can start cutting interest rates. But at the same time, though, the monetary tightening is continuing via balance sheets, QT, not just in the U.S., but around the world. And just by keeping interest rates high for a while is its own continued form of tightening, because eventually somebody's debt is coming due and is going to have to reprice at a much higher rate than the rate on the loan that's coming due.
Right, which is, of course, to some degree by design. That's what the Fed has been trying to restrain the economy along those channels.
Correct.
I guess the question is, how fast does inflation have to get toward the target? The Fed's own published outlook is not anticipating getting back to 2% until after next year, and yet the consensus outlook was also that they would start cutting rates. So it seems as if, you know, if you have this general idea that moderating growth but not a plunge into recession is what we might have just ahead of us, the Fed might be cutting into that, at least on a kind of short-term basis, or at least sort of those insurance cuts people talk about.
Well, also the Fed's going to be, I think, at some point, and I think it's going to be 2024, where they're also going to be looking at the unemployment rate, which is all of a sudden near 4% at the highest level since early last year. That is going to also, I think, become part of the conversation. And it's on the inflation side, it's very important. Just because you have a two-handle on a particular month next year doesn't mean that the inflation battle has been won. It's a sustainable level of 2% that if the Fed is most focused on, not just 1 or 2 months here and there that we see that. Even if we have a one-handle, it's where does inflation on a multi-year basis eventually stop at? And I don't think it's going to be 1 to 2. I think it's going to settle out at 3 to 4, even though we're still going to get some 2% prints. And one thing with the labor market.
Oh, go ahead.
Sorry. No, one thing with the labor market. We saw in Friday's U.S. PMI from S&P Global, they said the services employment component dipped below 50 for the first time since 2020. So keep our eye on further softening in the labor market.
Yeah, I was just going to ask Peter if that's what you're getting from some of the commentary, because you put together a lot of what we get from corporate America, and I'm curious what your threads you're picking up on inflation and demand and whether they match the market expectations.
Well, the demand side, at least on the consumer end, is very bifurcated. Obviously, the upper-income consumer is still spending, although from Burberry, from Richemont, we're hearing some signs that maybe even the upper-end consumer is moderating some of their spend. And the lower-income consumer is clearly focused on just getting by and focusing on the stuff that they need rather than the stuff that they want. In terms of inflation, there's no doubt that it's moderating. It's going to continue to next year as the rent slowdown works its way through into the CPI stats. But again, after that fall back in inflation, are we just 1 to 2% magically going to stay there? Because there's one thing for the Fed to get inflation down. There's another thing for the Fed to keep it down.